First off, thanks for coming through and taking the time to watch my video. I really appreciate that. But I have to let you guys know that nothing I say is financial advice, and I'm not responsible for any wins or losses you take while trading, and I am by no means a licensed financial advisor. Now that we got that out of the way, let's go ahead and hop into this video. So here's a good question. What is the difference between internal and external liquidity? So when we have a trading range and we're moving through this range, and we've kind of shown the desire to move up. We're in a bearish range. So we're going to look for price to come back up. Here was our old range, right? What happened was we came down and we took the external liquidity. Now, why is it external liquidity? Because it's at the external point of the range. You went outside of the range to take it. You went to an external area of price to take this liquidity. Internal means it's just inside this range. So when we have internal liquidity like equal highs, we've got equal highs here, we'll just put an imaginary fair value gap right here and another one right here, and then another one right here. So theoretically, once price shifts up and it shows us that it's reaching higher with that market structure shift, then it's telling us we're reaching towards liquidity that's going to be internal to the swing range that we just created. Now, what kind of internal liquidity do we look for? Do we look for price to hit here and turn around and stop? No. Why? Because it's in a discount. Price is going to move from external liquidity back to internal liquidity in the opposing market extreme. Market extreme, premium, and discount. So below the 50% of a range is discount, above it is a premium. So we know that smart money sells from a premium. So if we're looking to get involved with the correct institutional order flow, we're going to look at price and areas of liquidity in a premium, because after all the internal liquidity is cleaned out, that's when we can look for the external liquidity. So we expect reactions at all zones, and we have a heightened probability once we move into a premium that price is going to react from maybe this area of liquidity and move all the way down to the external. But what makes this less likely is if we have a lot of internal liquidity remaining. So for instance, in this example, if price wants to come back up after that, it's going to take these highs. Then it might give another reversal signal. Now we can try to take this all the way down, but we have to understand that it's not as likely as if we had cleaned out all external liquidity. So price can give us our entry signals and tell us the market's reaching lower, but maybe it's just reaching for this lower, maybe a fair value gap here, because the true narrative is to continue pushing through the range and cleaning out all internal liquidity before the true move happens. So we can see this comes up, and then now at this point, when you get this kind of reaction here, now you can look to target the external liquidity of the range. And you're not going to stop here, and you're not going to stop here. You're going to take partials there. But if you're trading whatever time frame you're on, this could be used on a daily, weekly, hourly, 15-minute, 5-minute, 1-minute, whatever you're using. You can look at price in the sense that now we're likely to go take the external liquidity, because now all of this internal liquidity has been cleaned up. Everything has been taken care of. So there's no reason for price to move back up. When you're down here, sure, it could go down, but there's a possibility that it goes up here. Now, when you're up here, it's a better probability than here to go all the way down, but it's still not as likely as here. So that's why whenever people try to short every order block and target the week low, so to speak, that's why you keep getting stopped out. And that's why that doesn't work all the time. And that's why I really do not like a lot of the basic smart money concepts, because they're just selling a dream and just trying to make it as easy as shorting every 4-hour order block. And that's not how it works. So I hope that helped you, and that probably helped a lot of people. Just really go rewatch this. Rewatch as many times until it makes sense. Ask me any questions you want, but that is how you need to look at price. And you need to look at it in forms of how probable is this entry to take me to the external liquidity. Does that mean if it's not likely, you can still take a trade here, but be trimming heavier or taking full profits earlier on. Same as here. Now here, you should still partial. Don't get in the mindset that you're just going to take it all here, but still take partials, because again, we're only human. Sometimes we can be wrong. I'm wrong all the time. I was really wrong yesterday and it sucked multiple times, but today I was right. And I won bigger today than I lost yesterday. So that's kind of that's the reality of trading. but you always prepare yourself for being wrong. So you want to take partials at each area of liquidity along the way, but you can look to extend your targets fuller or longer whenever you have cleaned out all of the internal liquidity within the range that you're basing your trade off of. Thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content, and if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day, and remember, if you can't see the liquidity, then you are the liquidity.